So thank you everyone for joining us today for WealthE Wednesday. Today we're going to be discussing the deal that is currently on our Wealth Migrate marketplace and that will be qualified for the WealthE Wednesday reduced minimum investment amount. But before we jump into that, I just want to do a brief introduction of our revenue team. These are the individuals that are going to be interacting with you the most. Myself, I am Gabriela Farias. I'm the head of global revenue for the Global Wealth Group and Wealth Migrate. Joining me today is my colleague, Alex Westhazen, wealth consultant with Wealth Migrate, and you can see his colleague, Fritz Groys, here as well. Many of you may be familiar Alex and Fritz from previous conversations. They are to, do you have any questions about investing in any of the, and are happy to engage with you in a conversation related to it. Before we jump into the deal, I do want Alex to just give us a brief overview of our marketplace and how to invest, and then we'll speak to our current offering.
Thanks, Gabby. Yeah, thank you for that warm welcome. Welcome to all our viewers, wherever you may be on the globe. I see there's a few people I've been chatting to for a while, so hi to everyone. Nice to be here. It's been a while since I've been in front of the camera, so yeah, it's nice to be back, Gabby, and be co-host here with you. So it's kind of a interesting one because I've only been exposed to the way that our platform is investing into global real estate. Scott and many of our investors have actually in the past they had to fly over to America, the UK, Australia, set up structures, set up bank accounts, and go through that the headache of doing all that effort. And many of the clients we've had experience with have actually burnt their fingers sometimes. And through our platform, we've made it very easy actually to supply investors with an answer to invest in the global real estate as well as other financial instruments. So it's effectively just logging onto our platform and signing up, getting your profile verified, and then funding your wallet. And once your wallet is funded, you can, within 2 or 3 seconds, literally invest into a global asset. And that actually, it sounds very simple. There's a lot of complications and structures in the back end, but we've made it very easy for clients to actually achieve this. So that's kind of what the challenge has been and how we've answered that. And through the platform, you can invest into not only one asset class, but an array of different asset classes, as well as not only one country, but also diversify your capital into different currencies, sectors, as well as sponsors. And we are very passionate about offering diversification to our clients, not having to bet the farm on one deal and throw all your money into one asset and hope and pray that works. But actually, as Ray Dalio and many other very sophisticated investors say, it's like throwing sunflower seeds all over the place and then kind of forgetting about it and just letting it grow. So Gabby, that's kind of how I would answer that and what the platform is all about.
Great, thanks, Alex. And as Alex mentioned, it is quite easy, quite simple to just sign up, create your platform with us. You will need to be what we call KYC or Know Your Customer and AML, anti-money laundering verified. But our client relations team makes that process as painless as possible and can be as quick as becoming verified within a day. So once you sign up, you become verified. You can browse our investment offerings on our marketplace, secure your investment with us, and then track the performance of that investment over time. A light note on our fees and what they cover. So we do charge a 3% initiation fee that's broken up into platform services. So the maintenance of our actual technology and platform, structure services, actually setting up the legal structures or entities by which we are aggregating money and providing that money or that investment to our into the deals, into the sponsors, and then investor acquisition and marketing. So 1% each for a total of a 3% off of whatever it is that you do invest with us. And then should the deal be successful, which is always the goal with us, is to provide you successful offerings, we do take a 10% returns fee off of whatever capital gains you may earn. And
Gabby,
any questions on that, again, we can discuss if we have time at the end of this session, and certainly Alex and Fritz are here to answer further.
Sorry, Gabby,
yes,
just to add to that, that sounds very complicated, but we've made it very simple for many of our, well, all of our investors just to go and see what that actually means to your return. So if you log onto the platform, you literally click on the deal card and you scroll down to just below the summary of the deal. You'll actually be able to put the amount in that you're looking to invest, click with fees or without fees, and you'll be able to see what that does to your investment. And that return at the bottom, you'll see that there's the IRR and then the cash on cash. That return is pretty much after all of our fees, institutional tax, withholding tax, et cetera, et cetera. So that is what you get out of our platform. And the beauty is it's all returned back into your digital wallet. And it's up to you to reinvest that into any other deals, or actually if you'd like to withdraw it, it's very simple, just to through the KYC journey, as Gabby was mentioning earlier, you can nominate and verify your bank account onto the platform, and then with within 2 clicks, you can withdraw that funds out into that wallet, into your bank account. That's just important to also realize there.
Yep. And I see Jacqueline's comment here. Jacqueline and Trevor, having comments like that is always gratifying for us. So pleased to hear that the platform so simple for you to use in a supportive investment environment for you. Today, we're going to be discussing our current offering on the marketplace. This is an opportunistic senior living fund through a new sponsor of ours, the McFarland Group. You can see here that the minimum investment for today is $97. After this evening, I believe it's at midnight, that investment will increase again to $5,000 US minimum. So this is a really great opportunity to get into offshore investment in a quite interesting asset class, especially if you're looking to add some diversity and dynamic kind of depth to your current portfolio. Just a bit about the McFarland Group, because they are a new partner with.
Sorry, I'll let you finish and I'll add.
Alex, go for it.
Okay, cool. Now, just to mention what you just see the. Sorry, there's a delay, it seems. I'll mute.
Okay, so just with the McFarland Group, a new sponsor with us, they are based out of, I believe it's Dallas, Texas, $2 billion in value of completed transactions since forming. Combined, their leadership team has over or close to 6 decades of experience exclusively in senior living as an asset class. The organization itself is fairly small, with 10 corporate employees, but they do have a second branch or leg of their business that is actually in property management called Surpass Senior Living, with a larger headcount, larger role of employees. Their deals have averaged 28% IRR net to investor, and investments to date include $5 million committed into, that's a typo, it's meant to say 54 million committed to the fund, the senior living fund that we're going to be discussing today. The goal of the McFarland Group is to generate superior returns by acquiring poorly positioned or over leveraged or undercapitalized senior living assets that can provide an opportunity for acquisition at a steeper discount to cost, which creates wide margins of safety for investors. And in speaking to Matt Johnson, the managing director of the McFarland Group, and his team, this is something that they're very well experienced in and have done over the last, I would say, 2 decades that they have been in business. By the numbers you can see here, again, 20% IRR realized to date for their investors, 2.25% investor realized cash multiples to date. Some pretty large numbers there in terms of equity raised and the total cost of projects overall. And quite impressive by the numbers for our sponsor. Talking specifically about the offering on our marketplace is an opportunistic senior living fund. So this is not a brick and mortar property that you are investing in necessarily. It is something a bit more unique. The objective of this fund is really to acquire distressed senior living properties across the United States with an acquisition of more non-performing loans from lenders and deeply discounted value add assisted living and memory care properties. And the idea is to add value over a 3 to 5 year period, aggregate that into portfolios and exit and close the fund. The investment period is estimated at 18 to 24 months. The fund itself has been open for about 6 months now, so it will close likely at the end of 2021. It's when they will stop soliciting capital into the fund, rather. And they're using fundamental real estate and real asset analysis and research, along with some proprietary market demand analysis to really understand and underwrite the senior living properties that they'll be acquiring through this fund. Something that's interesting about the McFarland Group is that they do have a multidisciplinary approach that involves drawing from multiple disciplines within their company to gain full understanding of the complex situations of these non-performing senior living assets. They anticipate holding properties for a period of 4 to 5 years after acquisition, and during this time will improve the property value by investing directly in capital improvements or deferred maintenance by increasing occupancy, changing the operator of these senior living properties to an operator at a local best-in-class to a local operator that's more best in class and will be under their strict supervision. Many times change on-site personnel and invest training in their success is also going to be a part of that kind of improvement of these acquired assets. And in addition to that, they'll initiate new marketing campaigns and provide new working capital to see properties through COVID-19 and to realize 90% stable occupancy, at which point in time they aggregate the properties into a portfolio for an institutional exit, which they believe will produce a 15% premium over selling assets individually. McFarland intends to invest the fund over, as I mentioned, 18 to 24 months and hold each project for 4 to 5 years. The close and exit of the fund within 7 years. And this timeline works because by the time this fund is ready to exit, the oldest baby boomer will be 82 years old. And we expect that the demand for senior living to be quite strong and the appetite for acquisitions to be favorable with low cap rates and strong price per unit. So with all of that being said, the target returns for this fund ultimately is 20% or higher. And we'll dive into just a bit more on senior living as an asset class and kind of performance over time, and touch on some case studies of recently seeded assets to the fund, so you can see already what this fund's been able to produce. Alex, did I miss anything there that you want to highlight or touch on?
I think you covered it comprehensively. The only one or two things that I would like to add is that the fund itself is $100 million. They're looking to raise $100 million. They've raised 54 million so far to date. As Gabby said, they're looking to close it within the next few months. The partners themselves, McFarland has actually put in $5 million of their own capital, so they've got their own skin in the game here. And they, as Gabby, a few weeks ago, we were on that call with Matt. Matt mentioned that he's got a lot of families and friends that are involved in this already. So it's kind of very close to home. So that speaks towards what kind of confidence they have in this fund as well. they're not only going out to the globe, but actually going very close to people around them. The only other thing that I'd add is, all right, well, we're actually going to get into the demographics soon. So yeah, let's wait for the next slide and we can go in there.
Sure. So to understand senior assets and why this fund has come about through McFarland, we want to go back a bit and just discuss the current distressed state of senior living. Considered at this point more of a distressed asset, and that actually is because of the construction boom. It became very heavily saturated at which point in time you saw that in 2012, and shortly after the exit of the Great Recession, majority of these properties were being built in the Sun Belt, so in the kind of southern southwestern part of the United States. And really just unfortunately, because the market became saturated, there wasn't that high of a demand. The demographics, the population rather, that would be partaking in this asset class, there just wasn't as much of a demand there. And then also with the introduction of medical advances, technological advances, we saw that individuals typically are entering into senior living at later stages in life than historically has been the case. Occupancy declined during the construction boom, and you can see this here in assisted living, in independent living, and senior housing overall, kind of the decline there. Some steady growth up until 2015, and then again, more of a decline from 2015, 2016. And that again is a result of the market becoming heavily saturated. And then during construction, you can see here a majority of assisted living homes there. The occupancy rate drops, and then obviously with COVID hitting in 2020, significant drops in occupancy in the past year. So while COVID-19 definitely contributes to the distress of the asset, it's not the leading cause. I will say that it has certainly expanded and deepened the pre-existing distress in senior living, but McFarland does have a COVID plan in place that includes third-party consultants and details policies and procedures, not only for their current cadre of assisted living and independent living senior care homes, but for any future home or property that they acquire through the fund. And it's also important to note that they have a contingency built into their budgets that specifically addresses COVID should we see similar pandemics in the next 5 to 7 years. So with all of that being said, I know it sounds quite doom and gloom, and you're thinking, why on earth would I invest in this asset class? There is some favorable tailwinds here. I think the biggest demographic or data point for me that really captured me is that the oldest baby boomer turned 75 years old on the 1st of January, 2021. We know that individuals tend to go into senior care homes around the age of 80, 81, 82. Which is around the time that this fund is looking to exit. So the idea is to acquire these properties now at a lower cost as they're distressed, invest and put capital into them, and then exit this deal and sell those properties when the demand reaches peak. A recent analysis done that by McFarland provided an estimate of the amount of inventory that is actually going to be needed between now and 2040, 20 years from now, if today's penetration rates hold. And using population estimates from the US Census Bureau for the next 20 plus years, McFarland estimates that there's going to be approximately 880,000 additional units of senior care inventory that will be needed to serve senior households over the age of 80 through the next 10 years. And just due to those demographic patterns and the rate of change in demand, they're going to need with roughly 54 units per year required between 2020 and 2025, and then 95 between 2025 and 2030, and then an additional 105,000 between 2030 and 2040. So it is very much going to be a very real need for this demographic and for this asset class to increase availability and quality care in the market within the next 5 to 10 years. And McFarland's just trying to get ahead of the curve and do that now. With that being said, even with the recession, the market saturation, historical returns across senior living as an asset class have for on a 10-year basis, publicly traded healthcare real estate investment trusts or REITs, for which senior housing and care properties represent a significant share of those investment portfolios. They outperformed the FTSE equity REIT index and the S&P 500 index, and you can see that from this graph here. So certainly a lot of opportunity in this asset class, and yeah, it's I think something that's getting ahead of the curve, if you will.
Sorry, Gabby, if we could just go back to slide 15. I think just one more back. Another one. There we go. I just wanted to add to what you were saying here is the tailwinds and what's driving this demand towards the Sunbelt states is, as Matt mentioned in our meeting, there's quite a lot of demand from the northern states of the US moving down to the southern states. And this is being driven by, well, firstly, a combination of a lot of things, but effectively COVID has created a perfect storm for people to realize that we don't need to all sit in one room to have this meeting. Everyone can kind of work online and basically live anywhere in the world and make a living. So there's a lot of the 45 to 55-year-old demographic age group that is actually migrating down to Sunbelt states. And with that, they're bringing their parents with them at the moment. As we've seen, many of the kids are keeping their parents with them at the moment because it's a little bit too much of a risk to put them into the care homes at the stage. And at this stage, it's not really necessary. It's at a level of active care. So just being in a complex where your grass is cut and your lunches are made and you can kind of go and bowl and so on and so forth. So there's not a lot of need yet to put actually your parents into a care home, frail care, memory care, etc., etc. So this is what's driving the demand down to the Sunbelt states. And that's where McFarland is looking to purchase anything between 10 and 20 distressed care homes in those states down there. And that's actually where we're looking towards. So not actually just focusing where the demand is at the moment, where it's going. And that speaks towards what Gabby was saying here about the age demographic, is as we start hitting 2025, 2026, and so on and so forth, there's a very high growth spurt in the demand for assisted living, memory care, and so on. And that actually it's just growing at a very rapid rate. As we can see through the statistics and through all of these graphs, there's a very high demand of the older demographic getting into a point where they will actually need these care homes. At this stage, there isn't any need. So that's why the supply is way outweighing the demand. So it's as Matt says, this is a perfect time to actually get into this market. Since they've actually recorded to 2006, if I remember correctly, these are it's created the perfect opportunity now to kind of pick up these assets. Just to add to that, Gabby.
No, definitely. And as our kind of final talking point here, I wanted to just discuss two current assets that have been seeded assets to the fund and their performance in the fund. So, hello, Lee.
Everybody, apologies.
Um, so recently, McFarland acquired Autumn Leaves senior living home. It's a memory care facility. They purchased this asset. It was non-performing at the time, so they purchased the loan against it. At the point that they purchased this care home had a 40%, they purchased it at 46% of the current par balance. The property was built in 2012, so again, newer property to um, to the market, which speaks to the kind of saturation of the market in 2012 and beyond. And was completed in 2012. Occupancy at the time that they purchased this was, occupancy on June 30th was 76%, increased from 67% within just a few months of McFarland purchasing this property. So it's interesting to note here just what they were able to do in such a short turnaround time. You can see the LP return there of 17.5% IRR and a 2x cash multiple just for this property alone. And another interesting case is 2 Chappitt Street, which is actually a medical office that is next to a senior care home. So this fund, while focusing on senior care, may also at times purchase medical offices or medical buildings as well that supplement or support or in the same ecosystem as senior care living homes. And this one is actually quite impressive. At the time that it was sold in November of 2020, the group saw 505% IRR net to fund investors. So already this fund is active. They're currently seeking properties and making purchases with what capital has already been raised and seeing really solid returns from those properties. As they continue to raise capital into the fund, obviously McFarland will be able to make more purchases along this nature that have quite a big impact on returns for investors into the fund. And that's it for us today. We'll open it up to Q&A. If you have any questions, you can feel free to pop those into the chat box or into the Q&A box for Alex and I to address.
Sure, Gabby, that was perfect. We did a 31-minute overview on the McFarland deal. I think that's a record for us. Yeah.
No, it's a nice lunchtime, easy lunchtime session. What I do want to remind everyone is that this deal is available now. It's offered on our marketplace right now. And for today, it is a $97 minimum investment and something that you can take advantage of at this point in time. So feel free to log into our marketplace, read through the details of the deal a bit more, and secure your IOI or your pledge a little later.
Gabby, just
wonderful. Thank you, everyone.
Sorry, Gabby, last thing to add before we go. Just for the investors that's quite concerned on the low cash on, as you can see, it's only at 3.24%, but it's an IRR of 16.7. So one should see this as a capital growth component. As we mentioned, you're investing into a fund that's picking up distressed assets for the first 12 to 24 months. And then from there onwards, where the McFarland is looking to actually stabilize those care homes. And once they get to, I think the percentage is 78%, 87%, sorry. Once they get occupancy to that level, it's actually cash flow positive. Leading up to that percentage, they're actually just making sure that the care home doesn't go backwards, doesn't lose value. So meaning putting in new carpets, painting it, making sure that the value of the asset stays relevant. So you're parking your funds for 5 to 6 years, year 3, 4, and 5, you're looking to get some form of a yield that will be paid out per quarter. But you're growing your money at I think the equity multiple here is close to 3%. So you're tripling your money within that 5, 6 years. So it's a great opportunity to actually just take a little bit of money, put it aside, and then letting it grow, and then see it come to maturity in 5 to 6 years, and then again diversify it within that. Yeah, that's my closing thought, Gabby.
Brilliant. Thank you so much, Alex. And thank you to everyone who attended and joined us this afternoon. Have a wonderful rest of your day. And we look forward to seeing your investments work for you. Take care, everyone.
Thanks, guys. Bye.